Good morning and welcome to a new month, Friday the 1st of September. And oh boy, does it feel like it this morning with torrential rain across the London and southeast, which has affected some travel into the city this morning. But we're up and running on the early morning call and welcome as we look out towards another European trading day where we are expecting some small gains at the start of the session. But let's take a look at the headlines. We are leading on the US dollar. It's set for another weekly loss. We've got non-farm payrolls looming 1:30 p.m. today. We're expecting a print of 170,000. And economists looking potentially for a downside risk to that number as we saw challenger job cuts rising yesterday well beyond expectations, indicating that there is a softness in the US jobs market. Meanwhile, the nationwide index down by the widest margin month on month, year over year in 14 years. That's the biggest move we've seen, and we will be watching some of the house builders in this session in today's trade. Meanwhile, on the way up, oil prices. Analysts are raising their 2023 year-on-year forecast in a poll, and we're widely expected to see further restrictions on supply from OPEC driving the price up as we see a continuation of restrictions in supplies. Take a look at volatility. We are expecting a rise today on the European markets. I'll show you the London, German and French markets in just a minute. Direction of travel very much on the downside for the volatility market. I was talking about this just during the week, and we're talking about where to place your stop, pulling a stop in, making profits on the way down. We've got a green candle at the moment, but in fact, in today's session intraday, we've seen the lowest print we've seen since the 28th of July. So all the early work in August now offset by this first, or in fact, as of yesterday's close, actually, we were at the lowest point we were at since the 1st of August. So that's pretty much wiped out all, if not all, of the early August move. So volatility on the way down, indicating risk assets in favor. It was a down day yesterday, in fact, 2 days in a row on the 24-hour markets for the FTSE 100. In fact, the FTSE was one of the worst performers yesterday on the European markets amongst the major indices. Today, we've got a little bit of a gain, and we are expecting a slightly stronger start to the London markets when things get underway at the top of the hour. Ditto what's happening in Germany. It was a good day yesterday, broadly speaking, and we're holding on to the 24-hour market close. We're up around about 20 points, I think, on from the cash close yesterday on the German DAX. Not much of a move in terms of the main context. Same sort of thing in France. In fact, if anything, we're now, I think, possibly now looking, we are looking at a slight drop at the start now today on the 24-hour markets, according to the cash session, expecting a small decline at the start of today's trade. You can see the candle shape today. It's it would at the top of a move be a shooting star candle, but I think you can see there that there is that indication of a drop. Let me just quickly see if I can give you an indication as to how far down it is from the close that we saw yesterday at 1630. That was the candle we were at yesterday. So we are now below that. That closed out yesterday's session at 73.18 with 73.10. So we are down now on the French markets. That was an interesting candle in the last 30 minutes or so on the way down, indicating that all of a sudden 24-hour money is now going short on this market. So that's where we are in terms of the European trading day. Overnight in the Asia-Pacific markets, broadly speaking, a good day. No trade in Hong Kong today, so we've put the benchmark Nifty 50 up with a rise of 0.4%. Nikkei gaining by the same sort of percentage margin today. S&P ASX 200. Mixed session overall, and in the final throes of the trading day, down a margin of 1/3%. Now, Wall Street very much in focus today because of non-farm payrolls. 1:30 p.m. We'll be live for Beat the Street. Hope you can join us there for that on the IG platform, taking our own unique look at how to trade these markets. Dow, S&P yesterday, both on the way down. NASDAQ on the way up on the session in yesterday's trade, which is where I want to start. Because as of the high point we saw yesterday, we saw the highest print we've seen since the 2nd of August. A bit like volatility, pretty much offset all of the move on the way down the first couple of weeks of August. In the last couple of weeks, we've seen positivity. Today, though, looking as though, at the moment at least, we're slightly below the watermark on from yesterday's cash close. So the NASDAQ looking slightly weaker, 15,483. I want to show you what's happening with the broader market index. Same sort of price action we've got. Down for a second down the 24-hour markets at the moment. But as I said, it's all to play for because of the non-farm payroll number out an hour before Wall Street gets underway today. That was a 24-hour move yesterday for the Dow We're currently trading 34,761. But it is all about what's happening with the US currency. Let's take a look at the dollar because it is still down on the week. That was the Monday candle. We started up there, starting out at the beginning of the session on Monday at 103.86. We're currently trading at 103.40. Second day in a row now of gains for the dollar. Be interested to see how we go towards the numbers at 1:30 p.m. UK time today. The greenback's decline this week really kicked off at the release of the JOLTs opening jobs data on Tuesday, which was much weaker than expected, confirmed by softer ADP employment change data on Wednesday. And we saw the challenger number yesterday coming through. July was about 25,000 jobs lost yesterday, a whopping 75,000 jobs lost. This is what we're expecting today in terms of the numbers we're looking for the non-farm payrolls figure for August. We saw ADP create 177,000 jobs, down from 260 or 290 odd thousand, I think it was the previous month. Job creations 170,000, the forecast for non-farm payrolls, that's down from 187 in July. The unemployment rate remaining at 3.5%. Average hourly earnings rising, but not by as much as inflation, 4.4% up year over year. So, needless to say, this data is going to be closely watched by the Federal Reserve. The meeting is with a decision on the 20th, Wednesday, 20th of September. Headline inflation 3.2% in July. I beg your pardon. In fact, that's actually below, isn't it? That 4.4% reading headline inflation. But core inflation is a little bit higher. Softening jobs market, another indication the Fed tightening campaign is working, and the rates could be near or at the peak or closer to the peak. If they are still going to raise rates, then many are thinking it might only be another 25 basis points. We'll have to see how things develop there. But those are the numbers we're looking at there. And then again at 3 o'clock this afternoon, we get the ISM Manufacturing PMI data in the States, forecast there for a rise to 47 in August. That's contraction. It's underneath 50. That's up from 46.4 in July. A 10th straight month of contraction below 50. But as I said, the looking as though we could well get a bit of an uplift from the previous month's reading. So now for the next on what's happening, I want to take a look at this chart now. This is the dollar trading against the Chinese yuan. Dollar down relatively heavily today. Yuan jumping to a 3-week high against the dollar before eating into some of those gains that we've seen. You can see the shape of that candle, that hammer candle with the long handle there. And that to me indicates that perhaps maybe many think that the sell-off in dollar or the purchase of Chinese yuan has been overdone. The Chinese Caixin Manufacturing PMI unexpectedly rose above 50. That means it's an expansion. The index rising to 51 in August from 49.2 the previous month, beating expectations of 49.3. This was the strongest pace of expansion in factory activity in China since February, contrasting with the NBS manufacturing PMI data released earlier this week that showed a 5th straight month of contraction. Let's continue with a look at what's happening on the economy, but come back into what's happening closer to home with the nationwide house price index. And oh boy, what a number out today. The sharpest fall in 14 years, a much faster drop than expected, a sign that interest rate hikes are clearly taking their toll in the property sector, the housing sector. House price index falling 0.8% in August month on month. Expectations had been for a 0.3% fall. Year on year, down 5.3%. The consensus there had been for a far smaller 3.9% drop. There's no doubt that the house prices are on the way down. You can see this if you're comparing house prices on Zoopla month on month on month, and they are showing that house price sales are confirming what the nationwide is telling us. We get the Halifax next week, and we're widely expecting to see that be along the same sort of lines. Look, it's worth taking a look at what's happening with sterling. In the context of this, the Bank of England is expected to raise interest rates again. It's going to meet in a couple of weeks' time. Another 25 basis points widely expected. But I think so far as the other areas of the market to watch, this is clearly going to be something that house builders are going to be interested in. It's been a relatively strong week for house builders this week. As we see inflation come down in the house building sector, I was noticing the other day that we've got a drop for some of the timber retail prices and wholesale prices here in the UK. Steel as well is on the way down in terms of its overall pricing. It was driven up enormously, remember, over the last year or so because of supply chain issues and the general rise in inflation. So that has been one of the reasons I think why people have been buying back into house builders. But this number out today will only add to the further woes. So potentially we could well possibly see some downside for some of these companies. Taylor Wimpey, another one. Some of the big house builders will doubtless be reflecting this drop in house prices today. Persimmon is another one which is worth looking at. Another company which has a large chunk of house building cash movement in this country, and you can see not too far away from recent lows for Persimmon. So that's certainly a sector to watch out for today. Just want to steer the conversation around to more economic and take a look across the pond, because I want to go back to take a look at what's happening in North America with Canada. GDP out today, released at 1:30 p.m. today. Canadian economy expected to have expanded by 0.3% in the June to April period, slowing from the 0.8% recorded in the first quarter. All this, of course, is to do with what's happening on the interest rate picture in Canada. Like a lot of the central banks have been raising interest rates, and we'll be taking a look at what's happening with the Canadian dollar. This is the US dollar. In today's session, we've got a little bit more of a fight back for the US dollar. The US dollar has been down against the Canadian in the last few days. It's really been driven by flows against the US dollar rather than into the Canadian dollar, which of course is the end result of this when you get two sides of any trade. But it'll be interesting to see what happens today and what the GDP number comes out like with high interest rates in Canada. It's widely expected we'll see a continuation of the slowdown that we've been seeing recently for Canadian GDP. Now, let's take a look at some of the corporates. I want to begin, first of all, with some breaking news we saw just half an hour ago coming through from Boohoo. Let me just bring up a chart of Boohoo to show you what's happening with the company. This is the internet clothing retailer. It's been a lot of problems recently with the board and so forth. And we've seen, look at this, bumping along the bottom is the best way to describe this. Yesterday, we saw a relatively hefty gain of 8.1%. Now, yesterday it was notified that Mike Ashley, via Frasers, had increased its interest in Boohoo from 7.8 to 9.1%. Let me tell you, today, that's now gone out to 10.4%, which means that Frasers now has a voting interest in Boohoo. Today's news will, I guess, see another rise in the share price. And I suppose it was only to be expected that Frasers would want to put itself in a position where it ends up with more of a voice on the board. And this move today will take it up to that 10.4% it now owns of Boohoo. So that's potentially only going to be good news, I think, for Boohoo. Frasers has done an amazing job recently of buying at the bottom, and it continues to do so. I mean, we've been seeing it buying into Argos, into Currys, into other retailers that have been finding it going tough. ASOS is another one where Mike Ashley has been buying into. And so I'm interested to see what happens to Boohoo stock at the start of today's session. Let me stay on the charts again. I want to take a look now at what's happening in Tesla Motors. Go across the pond to take a look at the all-session stock here. It opens at 9 o'clock this morning. I guess we could get a reaction to some of the news out over a couple of hours ago that Tesla has slashed the prices of its premium Model S and X cars in China just hours after unveiling a refreshed version of its Model 3 mass-market family saloon. Tesla has marked down the price of its basic Model S by 14% in China, and its entry-level Model X sports utility vehicle by around about 18%. Now, Bloomberg is quoting the Tesla website on this, and I have no reason to believe that's not the case. So we'll take this as news that the company has done this action. It means that it eats into margins, but at the same time, it means that it becomes more affordable for people to buy these in China. Let me tell you, that 14% drop in Model S takes it down to $96,200. And that still is very pricey, I think, for a car which only does, 380 miles on a single battery top up. And of course, you've got to wait for the battery to be charged up as well, even though there are fast chargers around. Interesting to see what happens to Tesla. We'll get a reaction to this at 9 o'clock this morning, or sessions on the IG platform. Now, a couple of stocks out last night with earnings, and two very different stories, but both in the tech sector. I want to talk about Dell Technologies, first of all. When trading opens this afternoon in the US stock, it's not an all-session stock on the IG platform, but it did rise 7.8% in the post-market move last night after it came through with earnings. Let's take a look at what's happening. The company certainly seems to have passed the difficult corner that hit the sector recently. Earnings coming in at $1.74 per share, easily beating analysts' expectations of $1.14. Revenue also better than expected, reaching $22.9 billion. Now, Dell's servers and networking division performed well in the most recent quarter ending the end of June, rising 11% to $4.25 billion, driven by higher demand for AI optimized servers. Why not? Dell is optimistic about its future. It sees this trend continuing as it expects big tech companies' investments to rise. Dell now sees third quarter revenue between $22.5 and $23.5 billion, higher than previous estimates of $21.67 billion. As I say, we've got to look at this stock in the context of what's to come. I've drawn here what 7.8% looks like in terms of the recent rise that we've seen in the stock. And you can see that since these lows back here, we've had this wonderful run in the stock. It doesn't look like it's ending either. When trade gets underway later on today, widely expecting it to then hit levels not seen since the 11th of February 2022 in Dell stocks. As we've been reporting, it's clearly changed the overall feel and feature of what's happening with Dell. So 8%, I think it was up maximum yesterday in extended trade. It could push the stock up to that 18-month high at the beginning of today's session. Another tech stock, but a very different sort of story coming through from Broadcom. Broadcom has been trading at record highs recently. It released its quarterly earnings last night. It marginally beat earnings and revenue expectations in the fiscal third quarter, but the stock fell 3.4% in after-hours trade after forecasting fourth quarter revenue below Wall Street estimates. And a look at what's been happening there with Broadcom. Let me show you the long-term chart, first of all, on Broadcom, and you can see very close to record highs. Yesterday it was down, I beg your pardon, yesterday's cash session, it was up 3.4%, and then it fell 3.4% in after-hours trade. It expects the current quarter revenue to be about $9.25 billion, with the company anticipating analysts anticipated $9.25 billion, so that's in line. The stock expected to fall by about 2% at the start, I think today actually now, most recent quotes. A bit harsh, you might say, but it looks like some investors are cashing in after that staggering performance that we've seen. Broadcom shares hitting a new all-time high in yesterday's session and indeed closing at a new all-time high, having more than doubled in the past 12 months. Let's shift on to some of the commodities to watch out for. I want to begin with US crude, first of all, set to record weekly gains after 2 weeks of losses. This is US crude, not too far away from the recent highs that we've seen back on the 10th of August at 84.40, 83.53. If you get a break of that, well, then back to levels then not seen since November last year. Thursday, another strong session for oil prices. How can we explain that? Well, in the context of stalling economic recovery in China, it is a bit strange. US production levels at its highest since 2020. Reuters survey of 37 oil analysts and economists shows that they expect OPEC to keep supply tight and have raised their 2023 oil price forecast. Now, Brent and WTI both expected to benefit from this. Let me show you the Brent chart, not too far away as well there from those highs that we've seen at 87.85 back on the 10th of August. Let me just show you where they expect oil charts to be. They expect an average of 82.45 this year. So far, it averages 80.60, but many are expecting this to be lifted. That is the 90 level. I want to show you 90 because I'll show you in the context of a nice big round numbers. Now, that would be the highest print we've seen since the 17th of November 2022 if it gets to that level. And that would be a nice round figure to watch out for if we do see further upside in the price of crude. Interestingly enough, as a technical analyst, it's worth looking possibly as well at MACD on this chart, and we've just seen it flip. Show you that there. Let me show you what that means. You can see it just flipping above the red dotted line there, giving you a green histogram. Means that this is now in an area of the market where traders are looking for opportunities to get in long, which I think will give it a further impetus on the upside. And this move that we see in the last 24 hours really all been about that survey. Tonight, the market awakes to Baker Hughes data. Last Friday, the total rig count declined further by 10, taking the total rig count down to 632. The lowest count since mid-February 2022, the number of active oil rigs falling by 8 to 512. Let me just return to the charts and take a look at spot gold. Not much move, 1939. I'm waiting for some sort of a breakout between the recent lows or recent highs to give me any sort of bite on a new trade on gold. That's it. We'll be back at 10:30 charting the markets. Watch out for boohoo, potential another rise on the markets this morning as a result of that news about the interest of Mike Ashley and Fraser's, taking it now to 10.4% and a voting interest in the business.